Hello and welcome to virtual training on psychological development and investment, brought to you by Everything for Business. This training focuses on developing positive perception or attitude for an investment. Throughout this training, we would deliver lectures through videos and we will share important information about investment and how to eliminate fears while investing. Most challenging part of an investment journey is getting started. Many people begin with fears associated with losing money, making a mistake, or not knowing anything about the stock market. Although the stakes are high, investing can help prepare you for the long term. Making a large investment is bound to come with fears, but the first step to overcoming them is to get started. Not having enough money to invest, losing money, trust, making an investment mistake, or the stock market volatility. What will you learn after this training? You will understand how actually investment works because usually people do not know that how actually investment works. So throughout this training, we will also equip you with the understanding of investment working and how to minimize or reduce or even eliminate different fears that are associated with the investment. Virtual training on psychological development and investment, Video 1, which will tell you about basic terminologies of an investment. Brought to you by, again, Everything for Business. Because without knowing basic terminologies of investment, you would never understand how actual investment works and how these risks associated with them could be minimized and how to eliminate the fears regarding investment. Learning outcomes from this video. You will understand what is finance, what is investment, what are different risks and investment, who are investors, and what are different types of investors. Before going further, I would like you to answer these questions. What is finance? What is investment? What are different risks and investment? And who are investors? What are different types of investors? And also, please include all the fears that you have in your mind about investment. Understanding finance is the first outcome of this video. Finance means management of fund or money. You have money, you have dollars. Now, it depends on your skills, your management skills, that how do you use those money or fund in order to get efficient and effective returns. Finance includes some activities which is investing, borrowing, lending, budgeting, saving, and forecasting. You have $10,000, let's say for example. Now, it depends on you whether you want to invest that, whether you want to borrow some money from others and add that to your own money and then invest it, whether you are planning to lend this money to someone else who need it. Budgeting is all about planning for future, that what will be your expenses. Saving is all about how much do you save and how much do you invest. Forecasting is the prediction of future outcomes of your investment. So these all activities are part of finance. What is investment? Investment is the process of allocating capital to a financial instruments like stocks, bonds, backed by an expectation to receive certain benefits in the future. What does it mean? It means capital as your cash, it is your vehicle, it is your car, it is your building, it is your land, everything. You have human resources, this is all capital. But here in finance, we will deal with the money as your capital. When you invest that in company stocks or in company bonds, you would receive dividend on stocks and return on bonds. Benefits could be your dividends or your returns. Now, what is risk? Risk is actually a variation from actual results. In finance, risk is the probability or chances that actual results will differ from expected result. Risk is defined as the volatility of returns. Let's say, for example, from our previous example, you have $10,000 and you invest that. Now, you think that that would give you $100 as a dividend per month, but it may differ. It could be 80, it could be 120, it could be higher, it could be lower. So this is actually a volatility of return. So probability of getting actual dividend would be different. So concept of risk and return is that riskier assets should have higher expected returns to compensate investors for the higher volatility and increased risk. If you are investing in an organization or project which is new, which have no reputation, which have no good management, so that might be a very risky investment. So you need to have a higher return for that risk. There are a lot of other risks, but we have systematic risk and unsystematic risk in a broader way. Systematic risk is not in your control because it affects the whole market. There are certain types of systematic risk: political legal risks, interest rate risk, and social risk. What are political and legal risks? Political and legal risk means when government impose certain regulations on the businesses or the investment, so that could be a risk. Interest rate risk is also determined by the state bank of a country. It could be a risk because if they have higher interest rates, then it could be a problem. Social risk is you have to invest your money in a project which is socially acceptable. And systematic risk, it could be controlled because it is specific to individual organization or individual investor. It is also called diversifiable risk. It is also called non-diversifiable risk. Now, unsystematic risk types: management risk, operational risk, financial risk. Management risk and operational risk are specific to an organization. Every organization have different type of their management and operational activities. So that could be a risk because if the company do not manage the investment in an efficient and effective way, then it could be a risk for your investment. Financial risk could be, it is actually a leverage risk. Leverage risk is what? It is a combination of a capital structure, whether your company or project in which you have done your investment, they have their own money or cash, or they have borrowed money from others. Who are investors? An investor is an individual, industry, or a firm that puts money into a business for a financial return. So if you are an investor and you invest your money, you put your money in an organization, or you buy some stocks, or you buy some bonds from a company, then you are an investor because you have goals of getting some benefits in future. Different types of investors: individual or retail investor and institutional investor. Retail and individual investor who do their investment by their own. Usually they have less resources, so they invest in smaller quantities. While institutional investor, like there are different companies, there are different industries who invest in bigger projects because they have larger resources. And next video, you will understand how different investors perceive different risks. Why some investors invest and why some investors do not invest. What are the fears? What are the risks they perceive? And how to overcome wrong perception about risk associated with that investment. Hope you find this video fruitful and you understood. And next video, you will get some more information. So thank you so much. Take care. Bye.